When Sanjay and me started this in 2011, it was a very humble but also realistic target, right? So we raised a 100 crore rupee fund. So in those days, it was a $20 million fund. Now in dollar terms, that's just $14 million. So the rupee is taken a bashing. But the 100 crores was well thought through even back then in terms of what kind of risk we wanted to take. So we positioned ourselves like a super angel fund. But when we started, the market was very young. 2011, valuations were $2-3 million. So basically, you could put $200,000 and get 10% ownership. Market's very different. People want $2 million. And where does the confidence come from? Do you think the opportunity is inflated to 10x? Theoretically, yes. What we thought was a $100 million, exit opportunity 10 years, 11 years, 12 years ago. Today looks like $1 billion exit opportunity. So the market size has changed. The nature of entrepreneurs has changed. The quality of management you can hire has changed. Talent has been trained in the tens of thousands, under several hundred unicorns and maybe a few hundred sort of multi-$100 million companies. None of this existed in 2011. So in that context, it was a decent amount of capital. And back then also, while we operated like a super angel fund, we wanted to become an institution in the long term. And the institutional avatar means that you need to know which companies are breaking out. You need to have reserves to play deeper. You have to play pro rata. You have to hold your stake in your best companies. Then we layered another 65, 70 crores on top of that. And that was our first 4 years. Then we realized that our ambition is bigger. The market is changing. This is 2015. And we pitched a $60 million fund. And for the first time, we started getting international interest. If we had one company above 500 million in March 2020, today we have 10 or 11. So when you see that scale, you know something is going on. It's not like luck. It's not one vintage. It's not one sector. It's not one person in the team. It's everything. So Ashish has like 2 unicorns. I have one. Arpit has one. Sajid has unicorns. Sanjay has unicorns. So you're getting comfort that, these guys have gone from the 2 founders to like a 500. They've gone and building multiple scale across multiple sectors, multiple vintages, multiple geographies. We have even cross-border unicorns, right? So then people say, these guys know what to create good portfolio. And combination of all of this is why we jumped from 100 to 250. Some of the people who we pitched in 2014-15 for Fund 2 came in Fund 3 in 2018. So you have to also understand that it's a compounding effect of 2-3 different things. How great the market is growing, how well we are growing, and how long it takes for people to get conviction on a market. And therefore, ability to give that capital to us now is actually a function of the fact that we met some of them 4 years ago and some of them 7 years ago, right? So you think that the market, there's a funding winter, why are people backing Blume? They're backing Blume because they've seen us for 7 years, not for 7 months, right? So this is something that is lost on, fundraising in a fund environment as opposed to a company situation. It's a singular business, the metrics, exactly what you're buying. Fund is blind pool, right? So they know what I'm made of in terms of what risk we want to take as a team. That's what we pitched, but they have no idea what I'm going to invest in. Think about the challenge of returning the $1 billion. If you have a company where you own 15% and it gets sold at $100 million, logically, the $15 million is great. I take the money because that's where I got the exit outcome. But in the context of $1 billion, it's a drop in the ocean. So what happens when you raise larger funds? It's a curse of large funds. Is you start engineering outcomes to only be mega large. So the bar to play the deep core, my core check of like $2 million, keeps going up with it. So hopefully by now the ecosystem is broadened and you have trained your wheels to be able to find market teams that can actually build $1 billion value. Whether that goes IPO, whether that you get a secondary sale there, or whether it goes M&A is inconsequential. It has to look like a legitimate $1 billion value opportunity to the market. What does that mean? Typically in e-commerce, that would mean $300 million of GMV with $75 million of EBITDA, right? So is that possible? Can you visualize that when the e-commerce tech hits you? Right? If you can't, don't do the deal. There's nothing that will fix the lack of conviction on either the founder and the team or the business that will somehow correct itself 3 years down. Right? Which is why even the best of plans, 27 out of 30 people will say no. Nothing wrong, right? It's just that they can't imagine the scale that the founder is selling. Either because you say, hey, they're nice kids, but I don't think they can become a CEO of $1 billion company. Or this is a nice segment, but I don't think they can grow to beyond $50 million, while this person is selling me a $300 million dream. So the conviction has to match. So VCs, more often than not, will be proven wrong by great offers. Not proven right? So basically, you can sit on the sidelines and say, therefore I won't play most things because you're going to be wrong 7 out of 10 times. But you have to play the 10 to get those 3. Right? So what you do is you sharpen the edges of taking risk, which can give you these outsized outcomes, and hope that if you've played enough of that risk, that 3 out of 10 break out, and then you get those $1.5 billion, $2 billion outcomes, of which, thanks to this bigger fund that we have, we're not going to own 3, 4, 5% anymore. We're going to own 10, 12% at that point. So you own 10% of $1 billion company, you make 100. You get 5 or 6 of these, you're at about 500-600 million. You get one freak outcome which goes to $3 billion, and theoretically you can make $250 million out. Right? And then the rest of them, everything else you build over 3 years, 30 odd, 35 companies, whether it goes to 0, whether it goes to 2x, whether it goes to 5x, all put together will deliver you another 100 to 1. So that's the playbook. I think philosophically, our view is that we don't gain anything, we don't win anything until the founder wins. We get like some tiny percentage of the profits we generate for our LPs. Right? So at an individual level, because I have to share it with my colleagues as well. To put it in context, it's like a fraction of what the founder has to make. Founder doesn't win, where are you going to make any money? Right? So I think there's incredible alignment in the philosophy that you have to make them win. Right? And a lot of first-time founders, even second-time founders, we think, oh, second-time founders are great. Even they don't know how to start. Right? They make mistakes, they've come from a set playbook, they've entered a new industry, new team. So essentially, all you're trying to do is appear as if, and then eventually win over by actual examples that you're doing all of this for them. The success of the company and then the success of the founders. Hopefully, most of the time, they're aligned entirely, right? And we generally dislike founders where that is not aligned, right? So hopefully we're choosing the right founders to partner with. But once we've made that choice, then we're all in, right? So essentially we're saying, whatever you need, we'll try and be of some value, to that particular problem that you need to solve. Where 3 companies don't domicile in India. This time we had a freak outcome where, freak as in I didn't expect it, and there's a slightly divergent theme, but Indian money is coming in a big way. A lot more confidence, a lot more gumption to take this risk. So almost 40% of our fund is Indian money. So which means that I can't afford not to pool my capital here. I don't want to run 2 different structures. The minute you do that, because when you run 2 different structures, there's also conflicts of interest. When you do that and you pool it, everything looks like an Indian fund now, even though 60% of my money is overseas. So we're trying to work with the regulators. I also sit as IBCA chair, as you know. So we've taken a view that, look, if we see it as a global play, we don't understand global markets, they're domiciled overseas, it just becomes tough. Portfolio construction's been fairly well thought through now over the last 5-6 years. So we basically slowed down on the idea of generalists in the firm and started specializing in the firm. And this was something we put into motion in 15-16 because we realized that we can't keep pace at an individual level with every sub-industry, sub-sector knowledge, right? And so as early members, they all got first dibs on what they picked. But basically, wherever we have gaps, now we hire. And we hire into those gaps rather than actually try to, each individual doing everything. So if you can see now, you're absolutely right. Sanjay is focused on SaaS and enterprise software and cross-border opportunities. Arpit's focused on deep tech, emerging tech. So all the EV bets in this fund, the first 3 have gone through him. Ashish has a lot of history and background with fintech, and he's been my support cast on that all through. So he's only focused on fintech, right? And Sajid looks at all consumer SMB, marketplaces, edtech, commerce, all of that. And now we are nurturing sub-teams under each of them. So it's not like even they can scale beyond a point. So we have to build this as a unit which can actually add significant value to these underlying portfolio companies. I would say in 23, we'd still probably go down the climate path the most, right? Anything which feeds, technology that can actually conserve, whether that is, renewable power, whether that is measurement of various things, data in that space. It doesn't have to be one thing. It can be in any of these combinations. Fintech is vast, right? There's like the whole gamut. So we're looking at, currently, if you look at my pipeline, it looks like 2 or 3 things in the savings kind of space, savings wealth management space, right? We already have a bunch of exposure in insurance and lending, so I don't know if we'll do more. Sanjay similarly now is relocated to the US because most of our SaaS founders need a foot in the door in the US. And by being there, he's able to navigate them better into that market. I think, interestingly, we're going back and looking at some very interesting edtech plays that move towards high-end employability. So if you ask me, those will be approximately where we will end up making 2 to 3 bets each. Soccer. I mean, I've been watching it with. I'm a sports lover. I just love everything sports. No, interestingly, it is the first biography of Musk's, written by Ashley Vance. The person who I've read most in terms of philosophy and how they've invested, maybe Fred Wilson of Union Square Ventures.